Hey, what's going on everyone? It's Griffin here, and I hope you're all having a fantastic day as always. Now, I am super excited to share with all of you today's video for two main reasons. The first one being that Canadian bank stocks have all released their Q4 earnings, so you all know what that means. We're going to be doing our quarterly Canadian bank stock industry comparison video. But what's even more exciting about today's video is that we are super fortunate to get the chance to invite on the channel one of my good friends and fellow YouTubers, Daniel Pronk, so that he can share his wisdom and knowledge about Canadian bank stocks with all of us today. So with that said, Daniel, welcome to my channel. How about you take the next couple of seconds to introduce yourself so that my audience is more familiar with you and your work?
Hello everyone. Now, the first thing that I want to say is thank you to Griffin for having me come on his channel. As Griffin said, I am a fellow YouTuber, and Griffin and I really got to know each other because we both make financial content. And honestly, Griffin's channel is very similar to my own, and that's why we decided to team up and both tackle the Canadian bank's earnings today.
Well, thanks again for jumping into today's video, Daniel. How about we welcome him by giving this video an early thumbs up? This is new for both me and for the audience here, but I really think that both Daniel and I working together in this video is going to deliver some really valuable content. So as we've done in previous Canadian bank stock videos, we're going to be diving into an Excel spreadsheet analyzing all the Q4 data of 6 of the top Canadian banks that were requested by the audience. This time, however, switching out the Laurentian Bank and National Bank for the Canadian Western Bank since it was highly requested by the audience in the last video.
I personally have been waiting pretty patiently to see how Q4 has compared to the previous quarters with banks' earnings. And this quarter proved to be quite a bit better than Q1 and Q2, where banks were anticipating to have billions of dollars in loan losses. However, at this current point, we are not yet out of the woods regarding the pandemic. But with all of the talk of a housing crash and a potential stock market crash, taking a look at banks' earnings can really give us a deeper insight to what these banks are expecting for the future of the economy. In fact, even though the Canadian banking industry has been one of the hardest hit industries in Canada, as we can see from the TXBA, which is a Canadian banking index, that banks have almost recovered to where they were even before the pandemic.
Those are some really great points, Daniel, and an awesome introduction to all the information that we're about to look over. So without further ado, let's jump right into the Excel spreadsheet because we have so much data to cover. And as always, if you want to follow along at home, you can download a link down in the description for your own copy of this spreadsheet. All right, so yeah, jumping into the spreadsheet here, a couple things to mention before we go any further. This is a bank stock comparison between TD Bank, Royal Bank of Canada, Scotiabank, Bank of Montreal, CIBC, and the Canadian Western Bank. All the numbers here are for Q4 2020 unless otherwise specified to be from Q3, and all the values are in millions of dollars unless they are percentages, ratios, or per share values. Let's now start at the top though with the current market cap of each one of these stocks, and note that this is as of December 10th. That's when I'm filming it in pre-market figures, which is a Friday morning. I also want to mention that for each metric that we will be looking at here, we're going to be going from left to right, starting with TD and then finishing with CWB, just to keep things orderly. So starting with TD, their market cap is still the second largest out of the bunch at around 131 billion with a share price of now $72.35, which is still down 4.8% from that 52-week high price point. With that said though, TD Bank is gaining some insane momentum as we can see here in the Canadian market, quickly catching up to RBC, which for the time being does still remain that largest player in the space though. Daniel, how about you share a bit more insight about why TD is gaining so much momentum over the past couple of quarters?
Well, the main thing with TD is that they are heavily exposed to the US economy, and the US economy has been recovering much more quickly than Canada's. TD's expansion into the US, in my opinion, is also why they're catching up to RBC and could potentially overtake RBC as the biggest bank in Canada. For example, TD just completed a merger with Charles Schwab, and they now own 13.5% of the company. And moves like this are why I see TD's growth accelerating beyond their peers. TD also announced that they're continuing to look for more acquisitions that make sense for the business, so I imagine that they will continue seeing accelerated growth for years to come.
Awesome, that was some really great insight. So how about we continue on down the sheet now? So Royal Bank of Canada does remain the largest bank at a market cap of around 151.5 billion, and their share price is above 100 now at 106.44, which is slowly creeping back up to that pre-crash high, but also still down around 2.95%. Now I'm not going to go through each and every one because that would take a lot of time, but as we can see, basically all of these banks have picked back up some stock price momentum as they've been able to to increase their top and bottom lines since Q1 and Q2. Even with these low interest rates in mind though, months later, as we just experienced in Q3, revenue growth was extremely nice, and for Q4, we're continuing to see gradual recovery. Speaking of top line, let's move on to the second block of data where we've input both the Q3 and Q4 revenue figures, giving us a clearer picture of which of these banks have managed to grow since last quarter. Interestingly, TD has once again had their best ever quarter, with revenues up a staggering 11% since Q3, sitting at $11.84 billion in revenue. Now, this is extremely impressive considering that the previous quarter had also been their best ever quarter in terms of revenues. So as a TD investor, these numbers are welcomed with excitement. This type of growth quarter over quarter is pretty much unheard of for a bank stock, but we're going to gain a little bit more insight as to why this has materialized. Now, surprisingly, the only other bank in this list that managed to increase their top line was the Canadian Western Bank at a 4.69% growth. This is a significantly smaller bank though that mainly operates in the Western provinces. That's why their figures are so much smaller than the 5 other banks. Now, for those other 4 banks that are in the big 5 banks in Canada, pretty disappointing, especially for RBC and BMO that weren't able to sustain that momentum that they had both managed to generate from Q2 to Q3, where revenues had really just exploded for both of these banks. It would have honestly been really nice to, at the very least, see from Q3 to Q4 both of these banks maintaining their revenues, even if it's somewhat stagnant, but double-digit revenue declines isn't necessarily something that I love to see. Nonetheless though, both of these banks are solid and have showed nice growth over the course of 2020 as a whole, considering all of these circumstances. For the next block of data, speaking about provisions for credit losses, I'm going to let Daniel explain what ended up happening for these banks over the quarter.
Yeah, so let's take a look at the provisions for credit losses, which once again, since last quarter, have decreased for each one of these banks. As we can see, 58% decrease for TD, 37% decrease for RBC, and 59% decrease for BMO. Now, if you aren't familiar with what provisions for credit losses are, let me explain. Provisions for credit losses are basically cash that the bank is putting aside in order to account for potential defaulting on their loans to customers. It's essentially the money that banks are setting aside to soak up losses on loans that default. The thing about PCLs is that when banks set aside this money, it goes against their net income, which is why all bank earnings were down when they set aside all of this money. However, at the beginning of the year, these banks were setting aside billions of dollars in provisions for credit losses because there was so much uncertainty around the pandemic and what it would do to the economy. And this really showed investors that these banks were anticipating to take on billions of dollars in loan defaults, and they were also anticipating that the economy was going to take a massive hit. But fast forward a couple of quarters, and as we just saw, provisions for credit losses have been dropping dramatically. This tells investors that banks are becoming much more optimistic about the recovery of the economy, or that they are more comfortable with their current provisions. And I see both as good things for banks, investors, and the economy. If these banks who hold all of the mortgages and loans in Canada are lowering their provisions for credit losses, then again, it must mean that they're more optimistic on the economy. So since PCL figures have been greatly reduced, we're now once again seeing net income figures growing by leaps and bounds, which is obviously a great thing for banks.
Provisions for credit losses really are one of those touch points that could be easily missed by investors, but gives us some great insights as to how the banks are interpreting the health of the economy moving forward. So thanks a lot for explaining that. Moving on down the Excel spreadsheet, the next block of data contains balance sheet figures where I've included some relevant information regarding these banks' financial positions that we would have been looking at in other company analysis videos. So we can see here liquid cash position of each bank followed by their assets and liabilities. And finally, there is this bank specific Cet1 ratio that we'll be speaking about. So FYI, this block of data, the numbers that are in green mean that the cash or assets position have gone up since Q3 2020, and then the red means that they've gone down. So leading the pack here once again in terms of growth since last quarter, we have TD Bank with a staggering $170.59 billion in cash, which has gone up since last quarter, contributing to their total asset increase, now sitting at $1.715 trillion, which is actually just incredible and hard to even wrap your head around. Now, in the last Q3 bank comparison video, there was still some confusion from some audience members as to the assets and liabilities of a bank as opposed to other regular companies that we're looking over. So let me reiterate what constitutes an asset and what constitutes a liability in regards to a bank specifically, because this is different than basically any other company that we actually analyze on the channel. Now, with other traditional companies, assets include cash, property, goodwill, short-term investments, receivables, and the list goes on. However, with banks, assets are actually loans that they provide to their customers. And this is because when a bank loans out money, they have entered into a contractual agreement with that borrower to receive payments each and every month, right? With a portion of the payment that is interest. It's for this reason that a bank can put these loans in their asset column, because the loans generate them income regardless of what those loans are actually used for. So now that we have a better understanding of what assets are in regards to a bank, we can see that TD has greatly taken the lead since last quarter when TD and RBC had almost identical asset figures. In fact, other than CIBC though and Canadian Western, the three other banks of those big fives had significant decreases in their assets.
Now, aside from the fact that banks have different assets and liabilities than other types of companies, they also have a bank-specific CET1 ratio. This ratio divides the liquid assets that a bank has by the total assets and gives us a percentage figure. The CET1 ratio is really important for banks because their loans are considered assets. And for this reason, taking a look at the total amount of assets that a bank has doesn't really tell you how financially sound that bank actually is. And this is because banks cannot cash out on loans for instant access to liquid money. So to put it simply, the CET1 ratio just tells us how much of the bank's total assets are actually liquid. Simply put, the higher the CET1 ratio, the better. And again, TD has performed the best this quarter, managing to increase this to 13.1%, which is significantly higher than any of the other banks. And somewhat unsurprisingly, CWB has the lowest CET1 ratio. Now, the reason that this is so important to mention is because banks generate a high percentage of their income from interest. So if interest rates remain low like they are right now, then banks could lose large portions of their revenue from interest rates being low. And actually, we're already starting to see this with TD. Their net interest income was down about 22% year over year in Q4 compared to Q4 of 2019. So if a bank has a lower percentage of their revenue coming from interest, then it means that their revenue isn't at as much risk while interest rates are so low. In fact, this brings me to the next section of the spreadsheet where we compare the percentage of income from interest to the non-interest income. And by the way, non-interest sources mostly represent banking and administration fees. Even considering TD's explosive revenue growth, they still generated 53% of the revenue from interest. RBC actually generated more of their income from non-interest sources, such as trading and insurance fees. At only 45% from interest, I see this as a very good thing. The bank that generated the most income from interest is CWB, at a whopping 87% from interest. This simply means that with lowered interest rates for the next couple of years, this bank may have a much harder time generating increased revenue.
All right, so we've pretty much gone through all the relevant financials and metrics for each of these bank stocks over the Q4 period, and we're now going to be speaking about their overall valuation as of right now and whether or not they still represent a good dividend positions for a dividend portfolio. So moving on to that next block of data here, these three rows contain their current trailing 12 months price to earnings of each of the banks, and I've also gone ahead and calculated each one of their 5-year average price to earnings of each one to determine whether or not these companies are at a discount right now, strictly from an earnings standpoint, especially since now the banks are showing increased net income figures after having decreased net income figures from their provisions from credit losses over Q1, Q2, and a little bit over Q3, but nonetheless, this does give us a good idea. So yeah, in regards to the price to earnings valuation, as of right now, TD as well as Scotiabank and CWB are the only ones that are still at a discount from a price to earnings standpoint relative to their 5-year PE. But even at that, I would take all of these figures with a grain of salt for this block of data, since the net earnings have been really skewed over the course of 2020. Most of these bank stocks have shown the lowest net income figures that they've pretty much shown in years. So that's really something to take into account when we're looking at, for example, an RBC that has a price to earnings ratio above their average 5-year price to earnings. This is really just because over Q1 Q1, Q2, and Q3, their net income was extremely low as opposed to over the past 5 years combined, and considering the fact that as of right now, the stock price is almost back up to pre-crash levels. And finally, diving into that last block of rows, which pertains to the dividend payout ratios as well as the dividend yields over Q4, well, none of these bank stocks ended up cutting their dividend, and with earnings having significantly increased over Q4, all of their dividend payout ratios have dropped down to more sustainable levels, which is really nice to see. And for this reason, I don't see any red flags here regarding dividends, and that they all show nice and healthy yields for a dividend portfolio. All right, so that was a ton of financial data to look over for each one of these bank stocks, but let's now try to boil all of this information down to make some final sense as to which one of these banks are best positioned based on these updated Q4 numbers. First of all, we've spoken about this company before, but Royal Bank of Canada pretty much always going to be a solid pick. The revenues are down for the quarter, but this is mainly due to that interest income, which was lower for Q4 over Q3, and like with all the other banks who just experienced the exact same thing. Now, they also have a relatively high CET1 ratio, and their percentage of income from interest was only 45% in Q4, which for a period of low interest rates, as we're experiencing right now, is somewhat reassuring to see that they have significant other forms of revenue. And in addition to this, they also have a nice cash position, and their dividend yield isn't the highest of the list at 4.06%, but at a 48% dividend payout ratio, you really can't go wrong regarding dividend income for RBC, and long term, this is always going to be a solid dividend stock play for a Canadian bank stock.
With that said though, our favorite bank out of the bunch is actually TD, which may not be a surprise considering how much momentum they're gaining in Canada and the US. TD is honestly a really good bank, who I personally use, and after looking at the numbers, I really think that they will get through these times with their dividend intact and continue growing once again in the future. Analysts are actually expecting the revenue to continue growing and are projecting it to reach $43.2 billion by the third quarter of 2024. So not even the pandemic can stop TD, and I do really think that they're a great long-term hold with a very stable dividend. I do want to point out, however, that their non-interest income is up only because of this other income reported right here. They reported $1.167 billion in other income, whereas last quarter it was negative $533 million. We can also see that their other non-income sources were mostly flat quarter over quarter. So this is really where TD got this massive boost to the revenue in their most recent quarter. And the fine print right here has this to say: includes a net gain on sale of its investment in TD Ameritrade, primarily related to a re-evaluation gain. What this means is that TD's income jumped so much because of a re-evaluation on TD Ameritrade, which in my opinion isn't real income for the business. Without this re-evaluation gain, TD's revenue would have probably been mostly flat or up just a little bit quarter over quarter. Which also means that I will not be surprised to see TD's revenue drop next quarter, as this is most likely a one-time thing.
Alright, so that pretty well wraps things up for today's industry comparison video for Canadian bank stocks. We really hope you enjoyed it, and once again, if you do want to access this sheet yourself at home, make sure to check out the link down in the description. I'd also like to once again thank Daniel for joining us in today's video and sharing his knowledge about Canadian bank stocks. If you want to show your appreciation, drop a like on the video and also comment down below. And with that said, make sure to stay tuned for our collaboration video over on Daniel's channel, which should be coming out in the next couple of days. So head on over to his channel. You can find a link down in the description, or just search Daniel Pronk in the YouTube search bar and subscribe to his channel so that you're notified of that upcoming video and all of his other upcoming content relating to stock market investing, which is really detailed and it provides a lot of value. Daniel has great technical and business analysis skills that he shares throughout his content, which is why I really wanted to bring him onto the channel in today's video so that he could share his expertise. So on that note, thanks to everyone who made it to the end of the video. We really hope you enjoyed it, and I'll see you in the next one.